Hi, this is Aaron Andrew with Missed Fortune. What we're going to do today is go over how you access your money tax-free from a life insurance contract. So as you've probably read in Missed Fortune 101, Last Chance Millionaire, and Millionaire by 30, the 4 different books that we have, is we talk about how you can access your money tax-free from a life insurance contract. So first, I want to point out that in the Internal Revenue Code, Section 7702 is the section of the code that talks about how you're able to do this legally, taking your money out tax-free. And 101, just real quick, talks about how the death benefit transfers income tax-free to your heirs. And 72E talks about how the cash value, as it earns interest, grows and accumulates tax-deferred as well. But one thing to keep in mind, you have to keep the policy in force until the day you pass away to allow this to be tax-free. So first of all, let's talk about a fixed loan. Let's use an example that you put in $10,000 for 5 years into one of these insurance contracts. And that could be $100,000 a year for 5 years and putting in $500,000. You can put millions into these. You can put $100 a month. It doesn't matter what example, it all works. It's just a matter of we're going to use an example of putting in $10,000 a year for 5 years, $50,000. It grows to $100,000 after so many years, and we've got $100,000 to work with. So in that example, if you just canceled that policy and you wanted your $100,000, you put in $50,000 of after-tax money, because after-tax dollars always go into these insurance contracts. So the $50,000 you have in growth is going to be taxable if you just cancel the policy. So you say, I don't want to cancel and just pay taxes. I want it to be tax-free. So the way you do that is under Section 7702 of the Internal Revenue Code to do that. So that is where you borrow against the cash value. So let's say you have $100,000 in cash value. You want to take out a loan, and this is where people get confused that, I'm paying interest on my own money. No, it doesn't work that way because your cash value is still earning interest. So let's say you want to take out $10,000. So you take out $10,000. Now over here on this side, we're going to draw 2 lines here and show you what happens with your $100,000 of cash value. So first of all, you take $10,000 out in the form of a loan. Well, people say a loan, there's interest on that loan. Yes. And let's just use an example of a company that charges 3% on that loan. Now over here on your cash value, you've now got $10,000 that is going to be earmarked for that loan, and you have $90,000 really left over. So first of all, what is my cash value earning? Your cash value is earning anywhere between 0 on the low end up to maybe, let's say, 15% on the high end. Some companies give you most give you a 0% guarantee that you can't lose. You can earn as high as 12, 14, 13, or 16% depending on the life insurance company. And it's usually linked to an index like the S&P 500 or whatever index they use. So historically, they show about 8% average. So we're going to say 8%. So this cash value has been earning an average of 8, some years higher, some years lower. But this $90,000 is earning 8%. This $10,000 earned a guaranteed rate of 3. So this is where it's really important to understand what's happening. If you just had $100,000 in a savings account and you took out $10,000, you now have $90,000 left, correct? Same thing here. You have $90,000 really left over. You have $100,000 total, but this $10,000 is cash value earning a guaranteed rate of 3. This is a $10,000 loan that is being charged 3. So those two numbers wash each other out. That's called a preferred loan, zero wash loan, or a fixed loan is what the insurance companies call these. So this 3% that you're being charged and this 3% that you're earning, let's just go out the next year. They wash each other out. So you got $10,300. Over here, you made $10,300. So some people get confused in thinking that they take this 3% and it is being paid by the cash value. They both accumulate. So pretty soon, this could be $20,000 and this can be $20,000. But the nice thing is that this is guaranteed at 3, and this is guaranteed to earn 3. So these two wash each other out, and you have a net of $90,000. So because it's inside a life insurance policy, and because this section of the code, it allows you to do this and get it out tax-free that way, and your $90,000 is going to earn 8%. So over the year, that's going to be $7,200. So $97,200 is, excuse me, this is going to be $97,200 is what your cash value is worth at the end of the year, earning 8%. And again, that could earn 0, could earn 15%, depending upon what the index does that year. And that is how the fixed loan works. Now, some years, if it's in the first 5 to 10 years, some of the companies might charge you more like a 4% charge over here on this side. So they'll charge us 4% over here. They'll credit you 3. So it's not a zero-wash loan at first. It's maybe a negative 1% spread. Or they'll charge you 2.25 and credit you 2, so it's a quarter spread. Or the most is usually a 2% spread in those first years. Most of our clients aren't borrowing until retirement, so 5 to 10 years out in these contracts. So that's when you get the zero-wash loan. So that's how the fixed loan works. In these insurance contracts, once again, allowing you to take your money out tax-free. You can always pay the loan back, which increases the cash value back to what it was before, and allows this money, this $10,000, to earn the 0 to 15 again. So that's it for today. Just wanted to explain to you how the fixed loans work.